Hello, and welcome to this State Street Digital podcast. This is the second in a series where I'll be discussing subjects covered in our quarterly Digital Digest publication with the authors of articles from the most recent digest. I'm James Redgrave, Vice President of Thought Leadership and Editorial for State Street Digital, and I'm joined today by Nitin Gaur, State Street's Global Head of Digital Asset Technology and Design, and by Jay Biancamano, Head of Tokenization at State Street. In October's Digital Digest, Jay and Nitin contributed pieces respectively on governance challenges and solutions for decentralized financial networks, and on how ETFs could be a major beneficiary of the digital tokenization of assets. Nitin and Jay, welcome.
Thank you for having us.
Thanks, James. Glad to be here.
Thanks very much. So, Jay, starting with your article, we touched on the Ethereum merge and how that related to what you were writing about in terms of a proof of work versus a proof of stake model. Could you maybe go into a little bit more detail about what governance and decision-making will look like on the new Ethereum Beacon blockchain?
I do think that when we look at how we move from proof of work to proof of stake, I think what I like to use as an analogy is that more participation will occur with proof of stake than proof of work, because now you have people that actually have skin in the game, right? So you're thinking about a concept here where you're not competing, but you're looking to actually create an environment where there's mutual benefit for all participants. Whereas instead of creating a race to gain a coin, you actually have people looking for an end game where there's mutual benefit. There's a ability for us to scale up, and it allows for more participation and more say in the actual structure of the blockchain, which is more democratic, right? So I think that's really where you'll start to see more new entrants into the space due to the proof of work movement to proof of stake. And Nitin, I would appreciate your help on this one as well.
Thank you, Jay. And I think Jay was, just to build upon what Jay mentioned, it's a shift. So proof of work to proof of stake, as the term suggests, as Jay touched upon, that proof of work was computationally heavy. It required a massive amount of coordination between the global computer systems, which led to a lot of energy consumption, which was one of the objectives of the merge. Second thing was the scalability, in the sense that transaction processing was rather slow, and proof of stake essentially solves both of those problems. So it is a shift in economic system of the network. What is the incentive economic mechanism, which early on was by solving a problem, a mathematical problem, which led to this sort of the race condition that Jay mentioned, massive compute power, to now dedicating your assets as a part of staking mechanism, which means that you are now ensuring the validation, verification of the network is tied to your assets that you're committing to voting system per se. And that, again, drastically reduces the compute network. With any change, I think there is a shift. Again, shift in economic systems, there's shift in technological systems, which means now I think what we are debating in the industry is that will these things make faster, but what are we giving up? And that is yet to be determined. There are some things, open questions in terms of censorship resistance, which is ability for these validators to be able to monitor and be able to provide some censorship on transaction. And that, again, is a hallmark of cryptocurrency and the decentralized system industry per se. But I think that is to be determined, I would say.
Yes, you mentioned censorship, and obviously there does need to be a mechanism to ensure that these people, even if their sort of economic self-interest should be dictated by their participation in the chain and their stake in the chain, there's always the potential for them seeing sort of forms of manipulation, for example, that would give them a bigger benefit than honest participation. So where do you see the sort of system of sanctions and checks and balances going?
Yeah. So if you look at recently, right, and I've been actually heads down on this, the first 3 or 4 months are crucial. And Ethereum post-merge has already achieved some of those sort of, milestones. So one, it's become deflationary for the first time, which actually happened through introduction of another project called Zen, which is XEN. But more importantly, I think that there was a report that was issued yesterday that 51% of the network now is embarking on the censorship of many of the OFAC enforced sort of element of Tornado Cash. So as you know, Tornado Cash was a mixer, which in most simplistic terms were trying to obfuscate a transaction, which again ensures privacy, but also led to a lot of nefarious activities that are happening on crypto space. And in many cases now that after the OFAC imposed a restriction as a part of sanction list on the Tornado Cash, a lot of these validators, which essentially are the entities that ensure the verification validation of these transactions as they stack them up and propose the block, have begun to now have a mechanism which, again, flashbot and MEVs are the terms that we use in the industry, to be able to remove these transactions. And while that's the right thing to do in many cases to ensure that we're adhering to some of these sort of regulatory requirements, I think the industry in general, which started out again with Bitcoin 14 years back, in ensuring that there is no censorship. And I think that's the conversation we're having in the industry now, that all these transactions that are emanating from Tornado Cash have been excluded from being included into the block, which prevents them from being processed. While it's great for the regulated industry and ensuring that we're adhering from a global network perspective, which, again, for the rest of the world that is not under the jurisdiction of the US, I think that's an open question now in terms of what is the pros and cons of achieving that level of censorship.
Yeah, I think when you look at what they're trying to do is to do self-regulation, right? Because if you think about how it's evolved, the regulation structure in the US actually is looking for the industry to do this. I don't think you'll have some central figure come out and say it's going to be X, Y, and Z. But I do think the industry is looking to do simply what the the financial services industry did 20 years ago, well, probably 30 years ago around derivatives, is to create a central point of self-regulation, a central point of rules. And even the exchanges like the Coinbases, the Geminis, and some of the New York things are looking to do self-regulation. So I think it's critical for them to get ahead of the curve. And I think one of the things the industry is hoping to do is actually lead the regulators in showing a preference for regulation and show that they can actually self-regulate, self-discipline, and create a scalability and a democratization of this technology that I don't think you would be able to find. I don't think anyone would be able to create a set of rules or documentation for people to follow. There might be some guidelines, but I think it's always going to come down to the industry itself in the crypto world to do self-regulation. It's not really just Ethereum as well. If you look at a lot of the other protocols, they're looking to do the same thing as well. So it's actually welcome, but you'll always have your outliers that are just like this flies in the face of convention, right? This is not why we created the crypto world, but we'll see how it shakes out.
That's great, thank you. Moving on now from this sort of specific crypto issue to wider issues of financial market infrastructure and the potential of tokenization to revolutionize them. We discussed in one of your articles how ETFs could become a major beneficiary of the tokenization of real or mainstream assets. And I was wondering if we could move a little beyond that to talk about what the implications of digitization and tokenization are for the packaging of investment products, fund structures versus bespoke portfolios, for example, for distribution, wallets versus more traditional brokers and intermediaries, and the use of digital assets in institutional portfolios. Would either of you like to pick up on that first?
Sure, I could jump in. I mean, we're seeing a transition now in the space. One of the reasons ETFs are so important because it allows participation without a lot of the risk that comes around with owning the underlying asset. If you look at the history of ETFs, generally it's, they were built for retail investors, even some small institutions, to move into asset classes that, quite frankly, had high amount of friction, had a high cost of engagement, and allowed participants to do so in a very easy, streamlined, and regulated way. So ETFs, I think, are critical for retail investors. I think they're critical for institutional investors. Institutional investors are looking at the space. They look at it very closely. Now, the interesting thing is, if you think about retail investors, we kind of have the benefit of being able to own the underlying cryptocurrencies. And I think pretty much everyone here owns some cryptocurrency in one way, shape, or form. Institutional investors are not allowed to do that in the US, right? So we have the 40 Act issuers that are looking into doing it. So ETFs allow them to participate in that. Now, they could do it through ETF futures based in the US. They have, and there's a number of global ETFs that are invested directly in crypto. We service Bitcoin and ETFs in North America here at State Street. So, but that's, I think, I hate to use the term, but it's so 2020, right? I think now what we're starting to see is a little more sophistication in the market. Many of our clients are moving into DeFi products, more sophisticated products that are moving beyond ETH. They're moving beyond to BTC. And those are the funds that are actually allowed to directly invest in it, the hedge funds, that are not regulated like the 40 and 33X. But beyond that, we're also seeing movements into crypto managed portfolios. We've talked to a number of clients that are actually looking to do SMAs for their clients and manage crypto portfolios. So, we're starting to see more sophistication. We're starting to see more sophistication in the underlying asset. We're seeing more sophistication in how clients are investing in these assets. And we're also seeing something I wouldn't say unusual, but we're seeing many products moving towards indexes, right? Crypto indexes are becoming the norm as well. So we've been talking to a number of clients looking to crypto indexes. So it's becoming very sophisticated. It's becoming very normalized in a way that we have, traditional assets have your indexes, traditional assets have your underlying ETFs. And in the crypto space, it's expanding. So I think really it's an exciting time because, clients are starting to understand these assets more and seeing opportunities outside of just Bitcoin and ETH. But it's also a very interesting time because the more sophisticated our clients become, the more sophisticated we have to become. And it's not a matter of catch up. It's more about understanding a lot of these assets and a lot of these structures that our clients are looking to invest in.
Nitin, anything to add to that?
So one thing I'd like to add to this, as Jay so eloquently described this, to me, we are solving, again, we've been down this path of digitization, both in terms of payment realm, but also digitizing our capital market infrastructure. And that process had begun 30 years back as, starting out with digitizing markets in general. I think what tokenization does essentially solves the issue of time and trust. And I think I've said this for the longest time, that we have this batch relay systems that many financial institutions who are part of this market structure. And the infrastructure that resides today provides not only the ability for us to digitally transmit information, but also the ability for us to ensure that we have the right reconciliation mechanism to ensure that the assets move from point A to point B and we have the right controls in place. And that oftentimes takes time. And that time has implications both in terms of the cost of locked capital, the transparency issues when we don't have visibility of that information, and over time, liquidity in the system in general. And I think what we see with DLT as rails, as transport mechanism, what we also see with some of the things with tokenization of these assets is not only we are compressing time in the sense that we have complete visibility of where the asset is, simply because of some of the tenets of the technology itself, things like transparency and things like immutability, transaction processing, they lend these characteristics to the visibility of assets. But more importantly, I think that while the industry is trying to change the market infrastructure by applying technology, which is asset tokenization as a primary sort of front, we'll find that in many cases, exactly what we have seen with internet. And I gave an example, as you know, James, in the article of travel agents, that while we don't have travel agents that we go to with green screens, we still have travel agents which are providing and curating our experiences. These are Trivago and Expedia that give you a holistic experience. They still do the same thing. And I believe that over time, as we tokenize the assets and as we are relying upon solving the issue of time and trust, we will see the shift and change in the market structure, which are the players who are providing some services in the industry. And that, to me, is the disruption. The question is, how do we, more of the business models, which, again, takes away the element of the friction and the cost that goes with it? And what is the new role of new intermediaries? Exactly, with my example of the travel agents. And that is, I think, TBD, as Jay mentioned, this is, again, a regulated industry. Everybody would like to have an exposure to not just crypto assets, but also would like to solve some of the incumbent problems, because our financial system has been there and was served as well, but it is aging and we need to fix it.
So the last thing I wanted to touch on was the potential of this technology to bring retail investors into traditionally illiquid institutional markets like private equity, private debt, infrastructure, real estate, etc., through the process of fractionalized tokenization. Nitin, would you like to kick off on that?
Yeah, I do. And I think Jay and me both have discussed this at length. I think private market is ripe. We've seen emergence of many digital TAs who have looked into tokenization as a starting point, and starting with T0 early days, and now we have a whole slew of players in that space. We've seen emergence of secondary markets in form of ATSs who are dealing with tokenization of assets. And what's interesting, and when I started out my career, I was working with one of the financial institutions in sort of creating the secondary markets, or essentially for private equity marketplaces, to essentially bring liquidity to a very illiquid market. And also solving for a lot of challenges that I mentioned with time and trust is a lot of these private markets rely upon massive documentation, massive verification, validation from the legal ecosystem. Even if you have a small change and you have the same structure with same instrument types, and then building a secondary marketplace that allows for various participants to be able to, engage in the transactional framework that was non-existent before. So I think private markets to me is ripe. I think that journey has already begun for quite some time that we all have seen with the industry. And it's quite, the pace of innovation and pace of adoption is quite rapid, only because of the fact that private markets are progressing, one, because of regulation. And second thing, I think in many cases that there's a massive need for liquidity and transparency, which today is pretty much, or historically was driven by this massive documents and peer-to-peer and point-to-point transactions. And now they're trying to standardize those things. So I think it's taken to me, private markets have skipped a generation of digitization and embarked straightly on tokenization, which I think, is quite remarkable. Jay, I'd love to get your thoughts on that as well.
Yeah, no, absolutely. I mean, one of the things that's excited me in the last couple of weeks was actually seeing what KKR did with their healthcare fund, right? So KKR is a private equity fund. The cost of engagement there was very high. Now they were able to fractionalize shares and offer shares that I wouldn't really say retail investors at $100,000 a coin, but it's a start. And I think one of the things that excited me about it was the fact that it's just the first one that's out there and it receives so much interest. I know, I'll be speaking to clients today specifically about that. And it's really about two things. The issuer is able to gain access to investors that it never had before, right? And say in an example where you have a private asset that's a specific company, that would allow somebody who's invested or did seed round for a particular company to capture some alpha by democratizing assets through tokenization. The second piece is now you look at the portfolio models that are out there in the market. To the typical investor, private equity, private debt, real estate has been inaccessible, right? Because of the cost of engagement, right? And if you think about real estate alone, how draconian it is, how long it takes to settle, literally in some cases months. Private debt is in some cases, 6 to 8 weeks. Now using tokenization and the blockchain, it could be done in minutes, right? You could also fractionalize those shares, allowing for more participants in the market. What does that lead to? Better price discovery, right? And it's a cycle. It starts to get that flywheel turning. And as I think what you'll see in literally the next few months is you'll see mutual funds becoming tokenized. You'll see mutual funds becoming tokenized is less about access to the retail investor, but more about making a market less friction, taking more friction out of the market by allowing more funds to be interchangeable by using a suite of funds that are tokenized. But I think you'll also see really private debt issuers coming out. And what that is going to create is a problem in the market. If you looked at what has been tokenized in the last, I'd say, 3 years, most of these tokenization I would say, endeavors were really tokenization about tokenization. Not a lot of, investable grade funds were tokenized. A lot of them were really unique, one-off. But now, with KKR, these are funds that are mainstream for institutional investors, and now people are starting to pay attention, and they're going to start investing in that. And that's going to create an infrastructure or a possibility of an infrastructure that allows for interchangeable of these assets. Because one of the other problems in the last 3 years has been many of these assets have been tokenized and then traded in a silo or held in a silo, right? If you want to access the KKR one, for example, I think you have to use the securitized UI. Many other tokenization projects have required you to access singular AI. So all these silos, I think, are going to have to be either merged or consolidated in one way, shape, or form to allow for interchangeable assets, interchangeable movement from one asset class to another. And what that will do will accelerate from the private markets into the traditional market. So I think really the next year, I would say it's going to be the age of private asset tokenization. And that's one of the things, as Nitin knows, one of the things we're looking very closely at here. One of the things we're very excited about. And it's not just us, it's our clients are excited about it, and their clients are excited about it. So it'll be a very interesting next couple of years in this space.
That's great. Well, Jay, Nitin, thank you very much.
Thanks, James.
Thanks for having us. Cheers.
Thank you for listening, and I hope you've enjoyed this podcast. You can visit statestreet.com for more information about State Street Digital Services and to read the latest Digital Digest.